The silent war between banks and blockchains. There was no declaration, no announcement, no clear beginning, just a growing tension beneath the surface of global finance. Two systems built on opposite assumptions, moving toward the same space. To understand why this conflict matters today, we need to look at what banks actually represent. They are not just places where money is stored. They are trust brokers, risk managers, and gatekeepers of liquidity. For decades, they shape how value moves, who gets access, and under what conditions. Their power was not loud. It was structural. Blockchains challenged that structure without confronting it directly. They did not ask for licenses. They did not lobby regulators. They simply worked. Value moved without intermediaries. Transactions settled without clearinghouses. Ownership transferred without permission. What felt like a technical innovation was, in reality, a governance shift. At first, traditional institutions dismissed it. The volumes were small. The users were fringe. The volatility looked reckless. Banks had survived countless innovations before. This one seemed no different. But beneath the surface, something unsettling was happening. Every successful transaction weakened an assumption banks depended on. That trust must be centralized. That verification requires authority. That access must be mediated. The system did not argue these points. It demonstrated alternatives. As adoption grew, so did the unease. Banks saw deposits moving, payment rails being bypassed, settlement times shrinking from days to minutes. Revenue streams that once felt permanent suddenly looked optional. This was not competition in the usual sense. No advertising, no customer acquisition campaigns, just parallel systems quietly proving they could perform similar functions. One relied on balance sheets and regulation. The other relied on incentives and code. The reveal came slowly. Blockchains were not trying to replace banks outright. They were unbundling them, separating custody from lending, clearing from settlement, trust from authority. And once that separation became visible, the conflict could no longer stay silent. As this unbundling accelerated, the quiet tension between banks and blockchains transformed into something deeper and more structural. A clash not of products, but philosophies about how financial systems should be organized, governed, and ultimately controlled. Banks had evolved over centuries to manage risk through hierarchy, regulation, and centralized oversight, while blockchains proposed that risk could be distributed, automated, and absorbed collectively through incentives rather than authority. For traditional institutions, this created a profound dilemma. The functions blockchains replicated were not peripheral services, but core mechanisms banks relied on to justify their role in the economy. Payments, custody, settlement, and record-keeping were not just technical tasks. They were sources of trust, revenue, and influence. When these functions began operating outside institutional walls, the threat was not immediate collapse, but gradual erosion. At first, banks experimented cautiously. Some explored private ledgers. Others partnered with blockchain startups. A few attempted to replicate decentralization within controlled environments. But these efforts revealed a contradiction. The efficiency of blockchains came precisely from removing centralized discretion, while banks depended on discretion to manage risk, comply with regulation, and preserve stability. Adopting the technology without adopting its philosophy produced limited results. Meanwhile, blockchains continued to evolve independently. New protocols emerged, offering lending, trading, and asset issuance without intermediaries. These systems did not ask whether incumbents approved. They only required users willing to accept new forms of risk. As participation grew, the line between experimentation and competition blurred. This growth unsettled regulators as well. Banks operated within well-defined legal frameworks, designed to enforce accountability and prevent systemic collapse. Decentralized systems operated across borders, jurisdictions, and legal definitions that had never anticipated autonomous code managing financial relationships. Enforcement mechanisms struggled to adapt, and uncertainty became a feature rather than a bug. The early conflict was not fought through policy or public statements. It unfolded through behavior. Users chose speed over familiarity. Developers chose openness over permission. Capital flowed toward efficiency, not tradition. Each choice was small in isolation, but together they reshaped incentives across the financial landscape. Banks still held power, scale, and legitimacy. But for the first time in modern history, they faced a parallel system that did not need their approval to exist. And that realization marked the beginning of a conflict that would only intensify as the two worlds moved closer together. The conflict intensified as both systems began encroaching on the same economic territory, forcing a confrontation that neither side had originally planned for but could no longer avoid. Banks watched as decentralized platforms offered services that looked increasingly familiar: lending without branches, trading without brokers, settlement without intermediaries, all operating continuously without holidays, closing hours, or geographic limitations. What had once seemed experimental now handled volumes too large to ignore. This overlap exposed a fundamental imbalance. Banks were constrained by capital requirements, compliance obligations, and regulatory scrutiny designed to protect systemic stability. Blockchain, by contrast, operated in a space where code enforced rules automatically, but accountability remained diffuse. This asymmetry allowed decentralized systems to move faster, innovate aggressively, and accept risks that traditional institutions were legally forbidden to take. As competition sharpened, narratives hardened. Banks framed blockchains as unstable, unsafe, and unproven, emphasizing consumer protection and systemic risk. Blockchain advocates framed banks as inefficient, exclusionary, and outdated, defending experimentation as the cost of progress. Each side spoke past the other, anchored to assumptions the other did not share. Behind the rhetoric, pressure mounted internally. Bank executives faced declining margins in payments and settlement. Younger users showed less loyalty to traditional institutions. Talent began flowing toward technology-driven finance, where incentives aligned with growth rather than preservation. The threat was no longer theoretical. It was measurable. At the same time, decentralized systems revealed their own fragilities. Hacks, exploits, and cascading failures demonstrated how quickly trust could evaporate when code behaved unexpectedly. Yet even these failures did not slow adoption. Instead, they accelerated iteration. Mistakes became data. Losses became lessons. The system adapted publicly, in real time. This resilience unsettled incumbents even more. Banks were accustomed to managing crises behind closed doors, coordinating with regulators and central banks to stabilize outcomes. Blockchains resolved crises in the open, through forks, protocol changes, and market responses that exposed every flaw. Transparency replaced reassurance, whether users were ready for it or not. As both sides pushed forward, it became clear that this was no longer a temporary disruption. It was a reconfiguration of financial power. Not a takeover, but a redistribution. Control fragmented, authority blurred, and the familiar boundaries that once defined the financial system began to dissolve. The buildup reached its peak as banks realized they were no longer competing against companies, but against infrastructure that anyone could use, modify, or abandon at will. And infrastructure, once adopted, is almost impossible to dislodge. The climax arrived when both sides reached the same conclusion from opposite directions. This was not a battle that could be won outright. It was a collision that would force adaptation on everyone involved, whether they welcomed it or not. Banks realized that resisting blockchains entirely meant irrelevance. The technology was not a passing trend. It was a new coordination layer for value. Ignoring it would not preserve authority. It would erode it. Slowly, reluctantly, institutions began integrating what they once dismissed, offering custody, settlement, and access to systems they could not control, only interface with. Blockchains, meanwhile, confronted their own limits. Total separation from the traditional system proved unsustainable at scale. Liquidity, compliance, and trust at the margin still mattered. Interfaces with banks became unavoidable. Fiat on-ramps, regulatory clarity, and institutional participation were no longer optional if growth was to continue. The resolution was not dominance, but convergence. Two systems built on opposing assumptions began shaping each other. Banks adopted automation, transparency, and continuous settlement. Blockchains absorbed governance, compliance layers, and institutional influence. Neither remained pure. Both changed. This uneasy equilibrium reshaped global finance in subtle ways. Power did not disappear. It fragmented. Authority no longer sat entirely with institutions or code. It moved into the spaces between them where incentives, regulation, and infrastructure intersected. Today, the silent war is no longer silent. It has become a negotiation, one that continues to redefine how trust is granted, how value moves, and who sets the rules. The future is not centralized or decentralized. It is negotiated line by line, protocol by protocol, and the outcome is still being written. Sometimes the smallest shift in perspective becomes the beginning of a new future. The